Hi there. Many UK taxpayers overlook their tax code until something goes wrong. Let's explain how tax codes work and how to check them for 2026.
Imagine opening your April 2026 payslip. Even if your salary is identical, your net pay, the amount hitting your bank account, might be significantly lower. This drop in income is the result of an automated policy shift by HM Revenue and Customs. Their systems are now programmed to remove specific tax reliefs from existing PAYE tax codes if they determine a taxpayer's status has changed. HMRC is automatically deleting historic employment expense claims exceeding £120, as well as higher-rate gift aid relief. Gift aid is a tax incentive that allows charities to claim the basic rate of tax on donations made by taxpayers. For instance, a hybrid worker who previously claimed relief for home working equipment may find that deduction has vanished from their profile. Without that relief, the amount of tax subtracted from their monthly salary increases immediately. Because these changes happen automatically, you cannot assume your current tax code is accurate. To protect your take-home pay, you must actively verify the details on your new P2 coding notice. To identify errors, you must understand your baseline. The standard tax code is 1257L. If you multiply the numerical part by 10, you get £12,570, which is your tax-free personal allowance for the year. The L confirms you are entitled to this standard amount. Your tax code also reflects your location. An S prefix indicates you are subject to Scottish income tax rates, while a C denotes Welsh rates. These regional bands often diverge from the standard UK thresholds. If you have a second job, you may see a BR code. This stands for basic rate, meaning all income from that source is taxed at a flat 20% because your personal allowance has already been used elsewhere. You may also encounter the K code. This represents a negative allowance. It is used when your untaxed income from other sources is higher than your tax-free allowance, requiring HMRC to collect the difference through your main salary. This alphanumeric sequence functions as a mathematical formula, calculating the exact amount of tax subtracted from your gross pay each month. The tax system becomes significantly more punitive once your earnings reach the £100,000 threshold. For high earners and business owners, this is a critical financial transition point. For every £2 earned above £100,000 personal allowance, creating a band where your effective tax rate hits 60%. A business owner can easily trigger this trap. By £125,140, the entire tax-free allowance is eroded to zero. Crossing this threshold requires proactive planning to mitigate the impact of the personal allowance taper and the resulting increase in your effective tax rate. Beyond annual income tax, there is a significant threat to long-term capital, inheritance tax, or IHT. This is the 40% charge levied on the total value of your estate, including property and money, when it is passed to your beneficiaries. To manage this, you can use a life insurance policy specifically calculated to cover the projected IHT liability on your estate. For this strategy to work, the policy must be written in trust. This is a legal arrangement that ensures the policy payout sits outside of your taxable estate. By using a trust, the payout provides your beneficiaries with immediate tax-free liquidity. This allows them to pay the HMRC bill directly, without being forced to sell family assets or business interests. Comprehensive wealth planning requires looking beyond your monthly tax code to protect the capital you intend to pass to the next generation. HMRC also utilizes your tax code to collect outstanding self-assessment debts through a process known as coding out. This allows them to recover tax owed by adding deductions to your monthly pay wages. This automated collection is only available if your total tax debt is under £3,000 and you filed your previous tax return before the relevant paper or online deadlines. There is a legal safeguard called the 50% rule. This prevents HMRC from making deductions that would leave you with less than half of your gross monthly pay. For example, if a landlord owes £1,200 in tax on rental income, HMRC may adjust their employment tax code to deduct an extra £100 per month over the course of the tax year. While coding out prevents the need for a single lump sum payment, it makes your monthly tax code appear more punitive. Careful review is required to ensure these deductions match your actual liability. April 2026 brings a mandatory change to how self-employed income is reported, making tax digital for income tax self-assessment, or MTD-ITSA. This initiative requires taxpayers to keep digital records and provide quarterly updates to HMRC. This timeline shows the implementation phases. Phase 1 begins in April 2026 for sole traders and landlords with a combined qualifying income of over £50,000. Qualifying income is your total gross income from self-employment and property combined. Under MTD, you must move away from a single annual tax return. Instead, you are required to submit digital updates every 3 months, reflecting your income and expenses in real time. Paper receipts and annual spreadsheets no longer satisfy these reporting requirements. Transitioning to compatible digital software is now mandatory to avoid late filing penalties. Log into the HMRC app and navigate to Pay as you earn. Select Check your income tax to view your itemized allowances. Cross-reference this list against your previous claims. You need to identify if vital employment expenses or higher rate gift aid relief were removed during the 2026 automated sweep. If the data is incorrect, use the Update Your Tax Code function within the app to submit your current evidence and securely restore your missing tax reliefs. Proactively auditing this digital profile is the most direct way to stop overpaying tax and reclaim your lost income. From managing the automated expense purge to meeting the new MTD deadlines, staying informed about these changes is essential for your financial security. If you need assistance with MTD compliance, tax code errors, or setting up life insurance and trust, contact My Tax Accountant. You can reach our team by phone or email for expert guidance on structuring your affairs. Like this video and subscribe to the MTA YouTube channel for more step-by-step guides on UK tax legislation. This video is for educational purposes only. You must consult a qualified professional before making any significant financial or structural decisions.